So as you're paying in this target premium, this flexible premium, this premium that is not fixed, every year more of the money has to go towards buying your term insurance, thus less is going to go into your cash value. Because every year term insurance is more expensive because every year you're 1 year closer to dying. That's just how it works. So less money goes into your cash value if you're paying this target premium. One of the features about universal life when it was first invented that people were told, now don't say this, but this is what they were told. They were told pay in your premium for so many years, and then when you don't want to pay the premium anymore, you can just debit your cash value and you can use it to pay your premium, which is true. You can do that. And it's not a loan. So long as this premium for the term insurance is paid, you will have your face amount. The term insurance is your face amount, $100,000 in my example. You can pay extra for what we call death benefit option B, which pays on universal life when you die, the face amount plus the cash value. So death benefit option B allows a beneficiary to get not only the face amount, but also the cash value. So people were told, debit your cash value, apply it to pay your premium, which you can do. That's no problem at all. It's not a loan, there's no interest, it does not affect your face amount. So that's nice. But then what happened if you got this policy in the early 80s was interest rates started to go down, which really wasn't expected. When interest rates are really high, we think they're going to be really high forever. Just like when they're really low, we think they're going to be like that forever. It's just human nature. So interest rates started to fall. People were taking their cash value out. And then all of a sudden, they realized that they had no more cash value. Their cash value was zero. So that if they had been paying extra for death benefit option B, there was no cash value to pay out. And when all was said and done, here they were 70 and their term insurance premiums were really expensive, and they didn't think they were buying term, they just didn't understand it. It was really confusing the way that it was originally sold. So universal whole life. For the test, you want to understand that the premium is flexible. If you don't pay the premium, can you debit the cash value and use it to pay the term insurance side of the equation? Absolutely. It's a flexible, not a fixed premium. Tied to interest rates, it's an interest-sensitive product. It goes into the general account. You can sell this with just your insurance license. Another interest-sensitive product that you probably will have a question on is variable whole life. So variable whole life is a policy that is tied to stocks. Where universal life was tied to interest rates, variable whole life is tied to the rate of return in the stock market. Tied to stocks. A fairly popular policy. In order to sell something that invests in the stock market, you must have not only your life insurance license, but you must have either your Series 6 or Series 7. And in order to have one of those licenses, you have to be registered with the NASD. Or well, they're really not called the NASD anymore. They're now called FINRA. But just in case your test still references, this was the National Association of Securities Dealers. It's got a new name now. It's now called FINRA. But sometimes the test is a little slow to update things. So to sell a variable policy, you have to not only have your life insurance license, but you also must have a Series 6 or Series 7. You must be registered with the NASD, FINRA. When we have variable life insurance, so this is a whole life policy, we have cash value, variable whole life, but the money is not going into the insurance company's general account. There is no guaranteed interest rate. It goes somewhere separate. It's called the separate account. So you pay a fixed premium. Variable whole life has a fixed premium. Be very careful on that. Sometimes we get so used to adjustable whole life had an adjustable premium that we think that when we use this variable product, it's talking about the premium. It's not. What's variable on variable life is the rate of return in the separate account. The premium is fixed. It will never change. But the but the premium goes into this separate account, which acts like a mutual fund and invests in the stock market. So invests in the stock market. And the guaranteed rate of return in the stock market is what? 0, meaning that there is no guaranteed interest rate. No guaranteed interest rate. So I can't draw you that perfect table of cash value like I did with the ordinary whole life policy because we don't know what we're going to earn. There's no guaranteed 4%. Cash value might do great, cash value might do not so hot. But when you buy variable whole life, it is still protection. So you have a face amount that is guaranteed. So the minimum face amount, let's say we buy a variable whole life policy of $100,000. The least that's going to be paid when you die is $100,000, variable life. But the cash value might do well or might not do so well. So if you have a cash value that's doing well, anytime, just like with traditional whole life, that you want to access the money in your cash value account, you can. So if you think about this, you've got a product that invests in the stock market and a way to take out money in the form of a loan. Of course, they're going to charge you interest on the loan, but you have a way of accessing your earnings that's not a taxable event, which is one of the features of a variable whole life policy that makes it so popular. So the least that's going to be paid when you die is the face amount. It's still protection. Even if the cash value does horrible, the insurance company has to promise to pay the face amount. But the cash value might do great. If the cash value does so well that when you die, there's more than needs to be in the cash value account, what's going to happen is they're going to take that extra amount of cash value and they're going to use it to buy life insurance on you. I know, you're dead. It's weird. But it's this idea that if there's $5,000 extra in cash value and you die when you're 40, let's say it can buy $20,000 worth of an additional face amount, versus the same $5,000 in your account and you die when you're 90, then it's only going to buy $3,000 in additional face amount. So variable life, could less than the face amount be paid when you die? Never. Can more than the face amount be paid when you die? Yes. Depends upon the performance of the separate account. So we take that extra, and on an annual basis, the insurance company will show you what this additional insurance amount would be based upon the cash value at that time and your age, of course, your gender at that time. It's based upon right then. So when you get this table of additional cash value, you don't know that that's what's going to happen when you die, because you might not die for 20 more years and your cash value might be totally different at that time. So the extra cash value is used to buy insurance. I know it feels kind of weird, but that's really how it works. It doesn't just simply pay it out. Because if we keep it in a face amount, then it's tax-free to our client or to our beneficiary. To keep the face amount tax-free, we have to get more insurance. So that's how that product works. So to be able to sell variable whole life, can you do it with just your insurance license? No. You have to be registered with the NASD. Have your Series 6 or 7. They're called FINRA. Variable universal whole life. So far the interest-sensitive products, universal life, variable whole life, and now we take those two and we put them together into another interest-sensitive product, and it's called VUL, variable universal life. A variable universal life policy. Do you still have to be registered with the NASD? Yes. Have your 6 or 7? Yes. Have your life insurance license? Yes. And what it's going to do is it's going to take the features of universal life, which is the face amount that's term, and then the cash value. But here we've got the cash value in the separate account. The main thing that's good, different from just variable life as far as your separate account goes, is that variable universal life is the only life insurance product that allows the client to self-direct funds within the separate account. What that means is that generally within a family of mutual funds, The insured can choose, do they want it in a growth fund or in an income fund or in an international fund or within the realm of choices that the insurance company has. The insured can choose how to invest their money in the separate account. That is only allowed on variable universal life. That's the only product that does that. Generally speaking, if they're going to ask, that's what they're going to ask you about. Variable universal life, the premium is flexible. It is not fixed. So to review, universal life had a flexible premium, a target premium they'll sometimes call it. Variable whole life had a fixed premium. Variable universal life has a flexible premium. It is not fixed. We also have interest sensitive whole life. Really, same thing as universal life, just a different name. So interest sensitive whole life is universal life. So we've already covered that. Interest sensitive whole life is an interest sensitive product, just like its name tells you that it is. Equity indexed life insurance. This is a policy that's become pretty popular over the last few years. Equity indexed life insurance. Type of a whole life policy. It's an interest sensitive product. It is not classified as a security, so not a securities product. So variable life and variable universal life, those are both securities products, regulated at the state level because insurance is regulated at the state level and regulated federally. Securities products are regulated federally under FINRA rules and under SEC, Securities and Exchange Commission laws. This product is not. This is not considered to be a securities product. So you can sell it with just your insurance license. That's kind of an interesting thing. That's great for you. You don't have to get your securities license. Equity indexed whole life has a minimum guaranteed face amount. So we'll say $100,000. And this time, the earnings are going to be linked to an index. So we're linked to an index. The most common index is the S&P 500. So Standard & Poor's 500 large cap companies. So that we have the money in the general account. It does have a minimum guaranteed interest rate anytime we have money in the general account. The risk is the insurance companies. But if the index does well, they will credit us with additional earnings. So it is possible to have more than the face amount paid out when you die, depending upon the performance of what? The index. So if the index does well, you have additional interest credited into your cash value account. Your premiums are never going to change. So depending upon the performance of the index, your earnings will fluctuate. But it has nothing to do with changing your premiums over time. So equity indexed life insurance. Good performance of the index is good for your cash value, does not affect your premiums. So within the topic of interest sensitive products, we had universal life, variable universal life, interest sensitive whole life, which is really just another name for universal life, and equity indexed life insurance. Remind me, was adjustable whole life one of these interest sensitive products? No, it wasn't. So make sure you don't forget that. Whole life, permanent protection until what age? 100. Not everybody can afford the premiums associated with a whole life policy. So maybe they just purchase term insurance. So term insurance, I gave you just a brief introduction as to what it was, how it worked. Term insurance is temporary. It is good for a period of time. Temporary time. It's cheapest in the short run. If you buy term insurance, like I'd said, it's generally 10 times less expensive than whole life. But if you don't die, you have nothing to show for it. There's no cash value. So it's most expensive in the long run. So if you have a client with a short-term need, term insurance is just fine for them. Sometimes you have a client that has a certain desire for a certain amount of insurance, but they can't buy all of that amount. Maybe they want $500,000 worth of coverage. They can't afford the premium associated with that whole life policy. So maybe they get a little bit of whole life and they get some term insurance as well. So that's a common thing that clients will do. Term, temporary, good for a period of time. No cash value. When you have a term insurance policy, how long your premium stays the same for really depends upon what kind of term insurance you're purchasing. So you can buy what's called annual renewable term, which means your premium stays the same for a year at a time, and then it renews, and then it goes up every year. Group life insurance is usually annual renewable term. So it gets more expensive every year based upon your clients getting older, your client's age. One of the things that term insurance policies generally are, in order to make them easier to sell, so they're easy to sell because they're inexpensive, but most term is what we call renewable. So if you got this annual renewable term policy at age 30, you pay your $100 premium. You do have to pass a physical exam when you initially purchase the policy. So they are going to put you through underwriting, make you go see a doctor, check all of your, make sure you're a healthy person, that you're not going to die tomorrow. They want to sell life insurance to people that are going to live forever, like me. So annual renewable term, you do pass a physical at the beginning. But this idea that term is renewable, the test loves this concept. It's renewable without a physical. So you pass a physical in the beginning, but when I turn age 31 and I want to renew it, in order to renew annual renewable term, all you have to do is pay the next more expensive premium. So your premium's based upon what's called your current or attained age, which in this case is 31, but it doesn't matter what my health is. So without a physical, another way of saying that is without proving insurability. Without proving insurability. You don't have to prove insurability ever again, only in the beginning. Without a physical exam. So that is a really nice feature that term insurance has, the fact that it is renewable, regardless of your health. If you purchase an annual renewable term policy, it's renewable every year. So it gets more expensive every year. So that's one of the great features that we have for term insurance. Test question, what kind of term is renewable? Answer, renewable term. You can do that. Are all of your questions going to be that easy? No. But that is an example of sometimes the questions on the test are that easy and you just don't overthink it. Renewable term is renewable without a physical exam based upon your current or attained, not original age. Another feature that most term policies will have is the ability to convert. You can convert without a physical, without proving insurability, to whole life. You can go from cheap to expensive. From cheap to expensive. The insurance company is more than happy to switch you out of the term insurance and get you into a permanent policy. So that's a selling feature. I know right now you can't afford whole life, but you get the term. This term is convertible. At any time that you want to, you can convert to whole life. We would be more than happy to let you do that. We won't make you take a physical. We'll charge you more for it. We'll charge you your premium based upon the age you are when you convert. So if you got your term when you were 30 and now you're 40, your premium for your converted policy is going to be based upon your current or attained age of 40. And we're going to charge you more because it's whole life, and whole life is more expensive. So on the test, what type of term is convertible? Convertible term. Convertible to what? From term to whole life. From term to whole life. No physical. Premiums are based upon your attained age. current age. Attained age and current age mean the same thing. So you can convert to whole life without a physical. Let me ask, if you had $100,000 worth of term, do you think you can convert to $500,000 of whole life? No. You can convert whatever face amount you had in term coverage to whole life without a physical. You can never increase your face amount without passing a physical exam. So renewable terms renewable, convertible terms convertible, without a physical, based upon current or attained age. Level term. There's different categories of level term policies. Level term policies are fairly popular when people have kids. So we have kids and we think all of a sudden, holy cow, if something happened to me, they're going to need some money if I was to die. So when you buy level term, what you're doing basically is you're saying, I would like to know exactly how much I'm going to pay for, let's say, 20 years. If I buy at age 30 a 20-year level term, so 30 to age 50, I'm basically paying a premium based upon an average age of 40 for 20 years. So with level term, the premium stays the same for however long the term is. So a 30-year level term, you'd lock in the premium payments for how many years? 30 years. 20-year level term, you lock in the premium payments for 20 years. So conceptually, if I have a 20-year level term versus a 30-year level term, which one is more expensive? So literally on the test, they give you, it's like a piece of paper, but it's really not. It's like a little flimsy laminated board thing. Write on it. If you don't write on it, oh, I'll be so sad. So write on it. So you've got a 20-year level term and a 30-year level term purchased at age 30. I'm basically saying, if I have a 30-year level term, that I'm going to pay a premium based upon the average life over this policy of 45. So which one is less expensive? A 20-year level term. So it's the application of the concepts that the test really likes. So level term has a level premium for however long you've locked it in for. You, of course, have to buy a physical when you first purchase. You have to pass a physical when you first purchase the policy. 30-year level term, you lock it in for 30 years, so the premium was more expensive because your average age is higher. So a question like that, definitely expect you to see on your test. Now, when you have level term, let's look at this 20-year level term. I didn't call it level, convertible, renewable, or anything like that, although generally speaking, term is renewable, and generally speaking, term is convertible. So when you have a 20-year level term, the feature that is most important that you understand is when you reach age 50, you can have another 20-year level term. The face amount will not change. So if the face amount's $100,000, that's still going to be $100,000. But if I choose over here to renew it, what's my premium going to be based upon? What age? My average age of 60. So can you renew level term? Generally speaking, yes, you can renew your level term. If it's a 20-year level term, you would renew it every 20 years. And obviously, the closer you get to dying, the more expensive the policy gets and the less likely the insurance company is going to want to let you renew it. So I'm not saying it's renewable till age 100 or anything like that. When you first buy the policy, you'd want to read the contract and see what it says. How long can you renew it for? Because statistically speaking, the actuaries develop the mortality table and, we're all going to die by age 100 anyway. So you can't renew it forever. But a 20-year level term you could renew for another 20 years in that example at age 50. So with level term, the premium is level for the term and the face amount is level, never changes. Decreasing term. I don't expect you'll have many questions on decreasing term. Decreasing term is used to insure a loan at the minimum cost. So if you were to have a loan, you're age 30, decreasing term. Decreasing term is the cheapest way to insure a loan. So here you are at age 30 and you just bought a house, let's say it's a $200,000 loan, and you get in decreasing term policy to insure the amount that you owe on the loan. Simplistically speaking, when I'm halfway through my 30-year mortgage, I owe half as much on my house. So my face amount goes down, decreasing term. The decreasing, the level, the face amount goes down. Level term, the face amount was level. The premium was the same also for level term. Decreasing term has a level premium, but the face amount goes down over time. So I pay in the same amount every year, but by the time I'm 60, my house is paid off, my protection is gone. I can't renew decreasing term because you can't renew a policy that's worth nothing at the end. Increasing term, the face amount would go up instead of down. We talked about the special features of term insurance. The test really likes these. Term is renewable without a physical and convertible to what? Whole life. When you renew it or you convert it, it's always based upon your current or attained age, but you're allowed to do so no matter your health. Return of premium is a type of term insurance that allows someone to, if they don't die during the term, receive their premiums back. Return of premium term insurance. So that's one of the things as far as term insurance goes. I said it's most expensive in the long run because if you don't die, you have nothing to show for it. So insurance companies came up with the return of premium term policy so that people could know that, hey, yeah, you're paying into this policy, but of course, return of premium will be more expensive than a policy that doesn't have the return of premium built into it. But with the return of premium, we'll pay you back your premiums if you outlive your policy. So it is a policy that you can purchase. It's not an emphasis on the test. So term insurance, temporary, good for a period of time, where whole life was permanent, lasts until you are age 100.